Good morning. It's Tuesday, the 24th of September, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take, speculation Sahi Nahi Hai. Now, there are several reasons why people gamble. They could range from the classic rush that one gets combined with the skill if elevated skills are involved in that game. And then many gamble or speculate just to make money. Now, there may be some distinctions between gambling and speculating, but it is quite clear that for millions of Indians, particularly younger ones that we are seeing off late, it is more the former that is gambling rather than the latter, which is speculating. After all, the essential principle is that you bet a small amount on something that could become bigger, whether in the stock market or crypto or some gaming app. Now, it turns out that those small bets are running into hundreds of thousands of crores. The aggregate losses of about 11 million individual traders exceeded 180,000 crores over the 3-year period between 2022 and 2024. In 2024, that's the financial year, individuals incurred something like 75,000 crores in net losses. In, again, financial year 2024, some 7.3 million individual traders lost money with an average net loss of 1.2 lakh rupees per person. And that number actually is pretty big, particularly for a higher or rather a smaller set of traders at the top. In contrast, foreign portfolio investors, that's FPIs, and proprietary traders booked gross trading profits of 28,000 crores and 33,000 crore rupees. That's 28,000 for foreign portfolio investors and proprietary traders at about 33,000 crore rupees, respectively. All of this is from a new Securities and Exchange Board of India study. It is also very clear that there are winners here, but there are the big guys who make the money while the small guys lose it almost consistently. And perhaps that's the moral of the story. But apart from the moral, the also sad part of the story is that algo traders, or those who use algorithms powered by high-end computers for trading, took the larger share of the pie. So most of the profits were generated by larger entities that use trading algorithms, with 97% of foreign portfolio investor profits and 96% of proprietary trader profits coming from algorithmic trading, according to that SEBI report. In all, 93% of retail traders in derivatives trading lost about 2 lakh rupees per trader in those last 3 financial years. So, SEBI has now proposed several measures aimed at curbing retail participation and speculation, and all of this is likely to figure and get pushed through an upcoming board meeting this month, according to a report in the Business Standard. The report also says that despite consecutive years of losses, more than 3/4 or 75% of the loss-making traders continued their activity in futures and options. So I guess some people will never learn. There are more and more grim and depressing statistics, but the larger point is that people are betting their shirts and losing them, whether in derivatives or crypto or some other mobile gaming app presented as a game of skill, something that seemingly tests your abilities but actually drains your bank account, usually at least. It's equally clear that technology, particularly through the mobile device, is accelerating this process with almost no friction. Frictionless transactions are a virtue and something to boast about, but only up to a point. It is no longer a virtue if it cannot introduce even a split-second pause that might make you think twice about moving your earnings into a speculative instrument. Not that a split second is enough, but we've got to start somewhere. For years, India's mutual fund industry ran a campaign called Mutual Fund Sahi Hai, or Mutual Funds are good for you. Whether because of that long-running campaign or despite it, the fact is that retail investor flows into mutual funds have hit record highs, over 20,000 crore rupees a month, mostly through the systematic investment plan route. Obviously, that campaign has worked in some way. It's time to say now that speculation Sahi Nahi Hai, or it's not good to speculate, or it's bad for your health. You might rightfully think and argue that such public service messages won't work, but no one thought that Mutual Fund Sahi Hai would work either. And that brings us to our top stories and themes in this somewhat market-heavy day. Liquidity surges drive Indian markets to fresh records and could take it up further. Foreigners own about $116 billion of Indian futures and options. Mutual fund investors are set to cross the 50 million mark. Oil prices enter the $75 a barrel range as a war kicks off between OPEC, that's the Organization of Petroleum Exporting Countries, and non-OPEC countries. And the rains are going, finally.
This is the Core Report with Govindraj Ethiraj.
Markets continue to ride the Fed Reserve rate cut wave. The Indian stock markets are continuing to ride the Federal Reserve rate cut wave and are likely to do so for longer, though with some pauses. Indian shares hit record highs for the third straight session on Monday as the US rate cut last week seemed to boost investors' appetite, or for that matter, risk appetite. The BSE Sensex and the NSE Nifty 50 hit fresh highs before closing at record levels on Monday. The Sensex rose 384 points before closing at 84,928 and hit a high of 84,980. That's almost 85,000 during intraday trade. Remember, I mentioned 100,000, which all seems closer. The Nifty 50 gained 148 points at 25,939, and thus it was very close to 26,000. So remember the numbers, 85,000 and 26,000. Both are obviously now imminent. The top performers on the bourses were Bajaj Auto, Mahindra & Mahindra, ONGC, Hero MotoCorp, and State Bank of India Life Insurance. All were up close to 4%. The broader indices also were up, including the Nifty Small Cap, the Nifty Mid Cap 100, and the Nifty Mid Cap 100 also scaled an all-time high during intraday trade on Monday. Elsewhere, the mutual fund investor base is set to cross the 50 million unique investor milestone in September, with net additions expected to exceed 10 million in just 12 months, driven by sustained buoyancy in the equity market and the surge in new fund offerings, according to Business Standard. Previously, it took the industry 21 months to add 10 million investors, while growing from 20 million to 40 million took over 26 months. So you can see where all the investors, or almost all the investors in the equity markets, have come, or rather when they've come, of course, worrying in its own way. The unique investor count is tracked using the number of permanent account numbers, which is used by the income tax registered with mutual fund schemes, according to the Business Standard. So all of this obviously goes back to that question on whether the slogan Mutual Funds Sahi Hai has worked or not, or clearly it's worked, but then the question could be to what extent. Meanwhile, Bloomberg also reported that with Indian stocks hitting successive records, global funds have pushed their derivatives wagers to unprecedented levels. By Friday, foreign institutional investors, or FIIs, owned about 9.7 trillion rupees, that's 970,000 crores, or $116 billion of options and futures on equity indices and single stocks listed on the National Stock Exchange, according to that Bloomberg data. The number of contracts now is over 500,000. That's the highest level since 2015. And the Nifty has rallied 18% now from a low that month to become one of Asia's top performers. It hit a fresh peak on Monday, as we just said, amidst a risk-on sentiment in global markets, said Reuters. So where is the market poised right now, and what are the directional signals at this point? And of course, how are valuations looking? I reached out to G Chokkalingam, founder of Equinomics Research, and I began by asking him how he was reading these all-time highs.
There is a lot of optimism. At the same time, all of us know there is a lot of fear also. That is because of small and mid cap. The combined market cap of small and mid cap is now 172 trillion rupees, 172 lakh crore rupees. That is why people are not able to digest when the Sensex and Nifty keep rising. So there is a dichotomy in the market. Sensex and Nifty should keep rising. Of course, there could be periodic profit booking and minor corrections, but I believe the trend is going to be very steady for Sensex and Nifty. There could be 6 to 10% further rise by end of current financial year. By end of calendar year itself, Sensex should touch about 90,000, which would be about 5.5% upside. So by next March, comfortably, they should rise 6 to 10%. Reasons? All of us know the Fed rate cut. This is only a beginning. Against a 500 basis rise, only 50 basis is cut down now, which is about 1/10 of the cumulative rise we have seen. So it is likely that there will be another minimum 100 basis cut before end of the current financial year. That should augur well for India. RBI should also cut down because the monsoon is too good, one of the best monsoons, and retail wholesale inflation should come down. Not only that, oil price is down 23% from 52-week high. That also should augur well. The problem of Chinese economy also should augur well for reversal of interest rate cycle, because that is the main reason for fall in the oil prices and other commodity prices. So monsoon has been good. The growth story remains intact. We are certain to hit 6.5 to 7%. The relative valuation also very comfortable for Sensex and Nifty. They trade at around 25 PE as against 32 to 35 PE for small and mid cap. So history proves the point that, beyond 3-4 years, this overvaluation of small and mid cap always get corrected, which is logical. So because of these reasons, I believe the Sensex and Nifty would keep rising, but small and mid cap should definitely correct. one good thing has happened. I was expecting some meltdown in the segment as a whole for SMC, small and mid cap. But what has happened in the last 1 or 2 months, certain pockets are getting affected badly, but not the whole segment is correcting. This is also healthy. There are several hundreds of stocks in the small and mid cap. It would be surprising to know they are already down 20 to even 40, 50% in the SMC segment. So this is one welcome development. So therefore, I believe, the whole market in terms of Sensex Nifty would be very strong, but one has to be very, very careful in certain pockets of small and mid cap, which are extremely overvalued.
So the correction that's happened in some segments or pockets, as you say, which in turn reflects certain sanity coming into the market. And what's that driven by, or who's driving that?
Obviously, in the large cap, the institutional players are there. But in the small and mid cap, there are many stocks where mutual fund holding is zero. So what happens in my learning in 32 years of this experience in stock market, what I learned in the small and mid cap also, there are two buckets of investors. One set of investors are, with entrepreneurial experience, HNIs. They have a lot of experience in the business and they are very smart. They are not carried away by perception-driven rally all the time. Ultimately, some point in time, they try to book profit because of their entrepreneurial experience. Or even if they are not entrepreneurs, just because they are successful HNIs, they have seen a lot of success in the business or market. So this particular pocket of investors, they tend to book profits when small and mid cap stocks individually, they hit abnormal valuation, mad valuation. So the second set of investors are basically the retail investors. As Dr. Kenneth Galbraith has mentioned, most of them are new investors. They come and burn the finger by buying the small and mid cap stocks at a super rich valuation. So this is what I observed in the last 30 years. So I think that's happening now also. So at some point in time, at the peak of the valuation, so many HNI entrepreneurial investors, they first book the profits and then the retail investors try to, compete in taking out a profit from such overvalued stock, and they fail, and then they start correcting very badly.
Are you seeing any specific trends in the large cap side? I mean, on the BSE, Sensex, or the NSE Nifty, which is really much bigger companies, older companies?
What is happening, Sensex and Nifty, different sectors are participating on a rotation basis. Till recently, the banks were underperforming. There are a lot of several headwinds. But suddenly you saw today, the banking stock rising. Earlier, IT stocks were suffering, but then they gave some leg up to the Sensex and Nifty. So I believe that kind of trend could continue. There could be a sector rotation and, so underperforming sector could come and rescue the Sensex and Nifty. We already saw a lot of FEI buying happening in the last few days post the rate cut by US Fed. So therefore, I believe it may not be confined to one or two sectors. Most sectors could do it, could come up on a rotation basis.
Hey, Chokka, thank you so much for joining me. Oil prices are steady. Oil is now steadying around the $75 a barrel range after a sharp jump in the last week, the biggest since April as it happened. Bloomberg reported that the strength in the dollar offset fears that the conflict between Israel and Hezbollah could morph into a regional war. There is, of course, rising concern that that war could worsen, threatening oil output in a region that supplies about a third of the world's oil barrels. Elsewhere in China, the world's largest importer of oil, there were hints that there could be more efforts to revive flagging growth apart from a cut in short-term policy rates. There is an interesting trade-off between the optimism around the US rate cuts, which has taken crude oil prices back up, versus the concern of falling demand from various quarters. And more on that shortly. A Bank of America analyst wrote that sentiment amongst energy investors has turned decisively bearish as OPEC Plus, that's the Organization of Petroleum Exporting Countries Plus, now adds or are the plans to add more barrels into a surplus oil market. According to the Bank of America analyst, $60 a barrel is a soft price floor to their central Brent forecast of $75 a barrel for 2025 if downside risks play out. I spoke with Bjarne Schieldrop, Chief Analyst Commodities at Oslo-based SEB Research that specializes in Nordic markets and, of course, oil. And I began by asking him where were prices headed now and what was the natural bottom, if there was one, at least for the present period.
I think it's too early to say what's sort of the natural bottom. But what we can say is that leading up to this fall down to $68.68 intraday low on 10th of September and then rebounding was big confusion about what exactly is OPEC Plus up to. What do they want? They said, okay, we want to add 2.2 million barrels per day over 1 year, gradually starting October this year. Yes, they had said, maybe we don't increase, maybe we do, depends on circumstances, but quite vague, the whole thing. So the market didn't feel comfortable that were they actually going to support the price or just straight out sort of adding supply. And then what we saw when price broke down below $75, almost immediately following that, it's a very sharp sell-off. OPEC went out, Saudi Arabia went out, they will postpone 2 months, right? We'll start in December anyhow. So it basically showed the hands of OPEC where is their pain point. And what they showed us was that they really want the price to be at $75 or higher, and they are ready to defend it by delaying the production increase by 2 months. It still kind of feels too much because they didn't sort of change the total amount of 2.2 million barrels per day increase, just shifted it out like 2 months starting December. And, adding 2.2 million barrels per day next year starting December is still way too much. So this is still hanging over the market, but at least we saw some response from OPEC. The moment we got under 75 and then tumbled further down, Saudi Arabia was like, 2 months out.
Right. So this is what OPEC is doing on the supply side. How are things looking on the demand side, including US and other economies?
Exactly. And that is, of course, the combo that made it very sort of problematic for the oil market, both the confusion on the OPEC Plus side, as well as strong signals of weakness, both in China, but also increasing weakness in the US. Thus, the double rate cut in one go from the US Fed, is sort of a response to the weakness they see.
And how are you seeing prices and trends in the next 3 months or so? And what is going to be the key driver? Is it going to be the supply side or demand side, or which is going to outweigh the other?
The demand side is really the big one, I think, to a very large degree. Of course, coupled with supply side as ever, but, the market is like, look at speculative positions in Brent crude. It's net short. And, it's been net short now for 2 weeks. Last week it was, or the week before last week, it was minus 13 million barrels. And the last data point last week was minus 8 million barrels. Those are the first 2 negative points in data going back starting 2011. The market is ultra short and ultra bearish oil. And still sort of the rebound here. So the market hasn't really changed its position in terms of what it thinks about the future. What we can say is that the current situation, just here and now in the spot market, isn't especially bearish. It's kind of balanced. What the market is saying is that going forward, it is going to be very bearish. And, it's kind of the vote of the market is that demand is going to be weak and supply non-OPEC Plus is going to be strong. And I think, the further information we get from the US economy of further weakness and also potential further weakness from China in terms of oil imports, those are going to be extremely important for what actually OPEC is able to handle. They are able to handle robust growth in non-OPEC Plus, but maybe it's going to be difficult to handle also weak demand at the same time, a potential US recession and further deterioration in China. That would be sort of very problematic, 2 negatives hitting OPEC from both sides, rising non-OPEC supply and global demand weakness. That would be sort of the ultimate negative cocktail.
Right. Are you seeing any shifts in production or source of production, between, let's say, Venezuela now maybe coming into the market, Iraq stepping up, the Emirates stepping up, at least from an India perspective? Are you seeing any shifts there? Russia, of course, going down slightly.
I mean, we're going to have some strong increase in non-OPEC supply from Brazil over the next 2 years, Ghana, Canada, and Qatar. Those are sort of the main contributors. And then, of course, it's always volatility in terms of production coming from Venezuela, Libya, etc. Those are the main sort of uncertainties very often. But, some of this uncertainty is rather robust supply growth from these non-OPEC plus countries. And that is sort of a challenge for OPEC plus, especially if demand is weak.
Right. Bjarne, thank you so much for joining me.
Thank you very much. Thank you. Have a nice evening.
Manufacturing slows. Growth in India's business activity slowed to a 9-month low in September amidst a slight cooling in demand and an uptick in costs, according to HSBC's Flash India Composite Purchasing Managers Index, or PMI, compiled by S&P Global. The survey also showed that services sector's jobs rose at the fastest pace in 2 years and overall activity remained strong, taking the expansionary streak, that's the 50 mark, separating expansion from contraction, to over 3 years. Nevertheless, the pace of growth remained well above the long-term average, according to HSBC. Rains are going. India's monsoon rains have started retreating, some may say finally, from the northwest of India on Monday, nearly a week later than normal, according to the government's Indian Meteorological Department, that's the IMD. India's monsoons provide roughly 70% of the rain India needs to water farms and replenish reservoirs and aquifers, and is a lifeblood of the nearly $3.5 trillion economy, according to Reuters, which added that the rains start to retreat usually by September 17th, but continued this year, which is good for reservoirs, but damaged the harvesting of crops that were ready in some states. Monsoon rains this year have so far been about 5.5% above average, and that was predicted, according to the India Meteorological Department. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.